what if I told you that the biggest crash in Ethereum this year is not the end of the story? It is actually the beginning of one. And what if the people who move right now, in this exact window, are the ones who look back 6 months from today and wonder why they ever hesitated? Hey everyone, welcome back to Smart Stock Sam. Today, we are breaking down why Ethereum's Elliott Wave structure is setting up what could be the most powerful crash entry for BMNR in years. We are going to cover the macro picture, the technicals, the on-chain data, and exactly how one company is positioning itself to capture the upside. If any of that sounds like something you need to hear, make sure you stick around, because every single piece of this puzzle connects. So, let's start with the big picture. The macro environment right now is doing something that does not happen every year. The Fed is cutting rates, but at the same time, it is draining liquidity from the system through quantitative tightening. Gold and silver are soaking up all the risk appetite that would normally be flowing into digital assets. It looks chaotic on the surface. But here is the thing most people are completely missing. The market has already priced in the worst political outcome, which means any sign of stability from here is not just neutral, it is a genuine catalyst. So here is a question for you. When was the last time the market actually rewarded you for expecting the worst? Now, if you want to know where the real institutional money is headed next, there is one signal that traders have watched for decades. It is called the January indicator. When the S&P 500 closes positive for the first 5 trading days and the full first month, the average annual return has historically landed around plus 18%. That exact setup has played out 36 times in the last 76 years. But flip that script if January turns negative, and the average annual loss drops to minus 5%. This is not guesswork. This is a pattern. And right now, it is pointing in one very clear direction. But do the technicals back it up? Let's find out. This is where things start getting really interesting. We are seeing a rare convergence of DeMark's timing models and Elliott Wave theory hitting the same target at the same time. The DeMark downside target of 2400 has been hit. Selling pressure is drying up. We are stuck in a resistance band right now, between 2289 and 2444. But the real question, the one that changes everything, is what happens when price punches through 2563. Because that level is not just a number on a chart. That is the line in the sand that confirms the bulls have officially taken the narrative back. But price alone does not tell the whole story. While Ethereum sits suppressed, its network utility is moving in the exact opposite direction. Active addresses are climbing. Traditional institutions are not just watching anymore. They are actively building on top of this network right now. You have got a textbook divergence between price and fundamentals, and historically, that gap only closes one way. The RSI is sitting right on a long-term support line, a classic bounce signal. So ask yourself this: can you really afford to wait until the price has already moved before you start paying attention? Now, one company is making a play right now that looks almost insane to the average trader. BitMine just locked in a purchase of 44,000 Ethereum at a cost basis of around $2,300. That is not a test. That is not a hedge. That is a factory owner buying raw materials at the lowest price of the cycle because they genuinely believe demand is coming back hard. They are not running from the bleeding. They are leaning into it. And when those previous highs around $4,000 come back into play, the people who held through this window are going to be sitting in a completely different financial position than everyone who waited on the sidelines. But this is not a blind bet. BitMine has a 4-point strategic checklist, and every single box is checked. Advisory support from some of the sharpest analytical minds in the market. An internal staking engine that is already live and generating real yield, a treasury that is deliberately overcapitalized to absorb volatility, and internal products already lined up for the next earnings cycle. The engine is built, it is running, and it is waiting. So here is the final thought I want to leave you with. In the world of institutional capital, volatility is not the enemy. It is the price of admission to the kind of returns that actually change lives. 3 to 5%, that is cash and treasuries, capital preservation. 10%, That is the S&P 500, solid, but it is not going to rewrite your financial future. But real wealth generation, the kind that shifts your entire trajectory, that lives in a completely different risk category. Right now, assets are quietly transferring from short-term thinkers to long-term builders. The storm is not done, but the people who build their position during the storm are always the ones who own the sunlight when it arrives. And trust me, it is coming. Finally, this video is for educational and informational purposes only and does not constitute financial or investment advice. I have expressed my analysis and opinion, and it does not necessarily mean a recommendation to buy, sell, or hold any security or asset. Moreover, all investments involve risk, including the potential loss of principal. Please conduct your own research and consult a qualified financial advisor before making any investment decisions. That is everything for today. If this breakdown gave you something to think about, hit that like button, subscribe, and drop a comment. Are you buying this dip or are you still on the fence? I will catch you in the next